Inflation has spiked over the last few years, to levels not seen since the early 1980s. This has put extra financial pressure on the British people, particularly the poorest. It's come from the three types of inflation you may have heard of in economics class, as well as a mystery fourth type. Cost-push inflation is when increasing costs for firms drive up prices. On the diagram, this is shown as a left shift in short-run aggregate supply. There are two big factors that have raised costs. COVID and the policy responses to it have caused many industries to shut down temporarily, and some firms to cease trading completely. Additionally, when restarting, many were operating at lower capacity. This has meant the global supply chain is less smooth, causing delays in obtaining resources and increased costs for these resources, driving up prices. A particular reason for these cost increases were the Chinese regulations that made trading more difficult and therefore more expensive, along with difficulties in global shipping that were further exacerbated by Russia's invasion of Ukraine furthered shipping disruption in the Black Sea, but has had a particular effect on the oil market, as many countries sanctioned Russia and reduced their demand for Russian oil. This demand was pushed into other oil markets, particularly OPEC countries. As oil is extremely inelastic, both in terms of supply and demand, this increased oil prices dramatically, causing surging costs for firms around the world. This has caused even greater SRAS left shifts, and therefore cost-push inflation. There's an argument that both of these effects could have lowered the productive capacity of the economy as well, shifting LRS to the left. These two effects are shown together using a Keynesian diagram. Whilst COVID was a financial strain on a lot of people, for others, it was a time where income stayed the same and expenditures decreased, both with a surge in working from home and the inability to actually go anywhere or do anything. As such, some were able to increase savings, boosted further by government schemes such as stimulus checks and furlough. When restrictions were lifted, the pent-up demand and increased savings could be spent, raising aggregate demand. This is particularly likely to cause inflation when occurring alongside supply shortages and not all firms fully reopening. Additionally, there's a lot of extra government spending during COVID, helping to keep AD relatively high when consumption and investment were plummeting. We've seen an unprecedented period of loose monetary policy since the global financial crisis in 2008. Most major central banks have had historically low interest rates, including negative ones in Japan, which may help to drive demand pull inflation through more spending and borrowing. It will also help to increase the money supply, as more loans are likely to be given out. The low confidence seen since the financial crisis is likely to mitigate this to an extent, as people and firms are less likely to take the cheap, available loans. Central banks have also been engaging in quantitative easing, creating money and buying government bonds from financial institutions. This increases the money supply, as they are creating new money to buy these bonds, and is also likely to stimulate additional borrowing. These actions lead to an increase in the money supply, which is likely to lead to inflation, as can be illustrated using the Fisher equation, which states that, assuming the velocity of money is fixed, i.e. units of currency are spent at about the same rate each year, and the economic growth is not directly affected by changing in the money supply, i.e. it's exogenous, additional money supply will lead to higher prices. Put more simply, if there's more money in the economy, more money will be spent. If there's no increase in production, this additional money is trying to buy the same amount of stuff, meaning the stuff will cost more money, so the value of that money decreases. A longer-term trend that's potentially supercharging the recent inflation is the growth of oligopolistic industries. We've seen firms growing, buying up competition and dominating markets. There's been increasing growth in the number and size of mergers and acquisitions. Firms are buying each other up more regularly, reducing competition. This is particularly true in industries that are key to the global supply chain, which are becoming much more consolidated. If firms have a greater control of the market, they know their consumers will not be able to shop around for better deals, meaning they can raise their prices, and consumers will still pay. Demand in many markets is becoming more price inelastic, and firms are more able to profit maximize than they could previously. Markets with less elastic demand will see higher increase in prices when costs go up, and markets that can operate closer to profit maximization will see increasing price, P2, up from P1. These two factors together will likely have contributed to increasing inflation. Whilst all four factors have played a part, evidence suggests that the bulk of inflation has been caused by supply-side factors. This is why it's persisted across nearly all countries, even when monetary policy has not been as loose. However, increasing money supply has been shown to raise inflation further. This is topped up by companies who are not incentivized to absorb these costs, as they have such limited competition, meaning these costs are passed on to consumers and employees, allowing the companies to make record profits. Fortunately, it seems as if the inflation spike is coming to an end. But if the last 15 years are anything to go by, the pain it's caused will take a long time to unwind.